All right, welcome to The Explainer. Today, we're jumping right into a clinical dissection of the strict, mechanical, and jurisdictional divide between two major tax reporting forms, Form 1040 and Form 1040-NR. We are going to cut straight through the surface-level paperwork noise to uncover the precise cause and effect triggers that determine exactly how your global wealth is exposed to domestic taxation. You see, based on in-depth expert analysis, this isn't just about figuring out which boxes to check. It's about fundamentally understanding bureaucratic boundaries and how they operate as rigid, highly structured jurisdictional triggers. We're going to look at the actionable insights, the implicit assumptions, and the completely non-obvious details that experts use to navigate this divide. Okay, let's dive into this breakdown. We're going to cover 5 key areas today. First, the jurisdictional residency trigger. Second, the scope of income exposure. Third, navigating dual status mechanics. Fourth, treaty overrides and exceptions. And finally, strategic tax liability implications. Let's get right into it. Starting off with Section 1, the jurisdictional residency trigger. So expert analysis indicates that which form you use is absolutely never arbitrary. It all stems from a strict binary classification. This classification is the exact mechanism that determines your initial reporting posture. Let's clearly define the foundational terms here. A resident for tax purposes includes citizens, permanent residents, like green card holders, or literally anyone who mathematically triggers the substantial presence test. Conceptually, this means spending a specific, calculated number of days within the jurisdiction's borders over a multi-year period. It is a pure math equation. Fail that metric or successfully claim a highly specific exemption, and you are classified as a non-resident. This simple binary acts as the ultimate jurisdictional tripwire, setting completely different reporting obligations into motion. And this draws a hard, impenetrable line between the two classifications. Form 1040 is the absolute default mechanism required for all domestic citizens and resident taxpayers. It operates under the structural assumption that you are fully integrated into the domestic system. But in stark contrast, Form 1040-NR acts as a firewall. It's required exclusively for non-resident taxpayers. It firmly walls off those strictly categorized as non-residents, ensuring they are processed through completely different analytical rules and, crucially, entirely different tax rates. But here is a completely non-obvious detail that traps a lot of people. Physical presence doesn't actually guarantee resident status. You can literally be physically standing on domestic soil for most of the year, but remain legally invisible to the substantial presence metric. How? Well, by utilizing specific exemptions that prevent a Form 1040 default. For example, if you're present on certain academic or training visas, you're largely invisible to the residency math for a set duration. Or think about a sudden medical emergency that legally grounds your planned flight out of the country that actually pauses the residency clock. Furthermore, you can formally establish that you have a closer connection to a foreign jurisdiction. Doing that lets you bypass the resident classification entirely, even if you cross the physical day count threshold. It's a precise strategic mechanism to bypass that default resident status. Moving right along to Section 2, Scope of Income Exposure. And this brilliantly illustrates the real-world impact. Now that we know the trigger, how does the assigned form mechanically affect your wealth? Well, Form 1040 asserts an infinite jurisdictional reach. Think of it like an inescapable gravitational pull, taxing a resident's worldwide income. It doesn't matter if you earned that capital locally or if it's sitting in a bank account on the exact opposite side of the planet, entirely disconnected from the domestic economy. It is a system of total capture. Form 1040-NR, however, is basically a geographical containment field. It operates with a strictly finite territorial reach, taxing only income that is specifically sourced domestically, right within the physical borders of the governing jurisdiction. To be totally clinical about it, Form 1040-NR only cares about the economic value you extract from within the domestic border. It captures domestically sourced investment income, think along the lines of local dividends or royalties, and income that is directly connected to a domestic trade or business. And that's it. This demonstrates a structurally limited, highly territorial scope. It completely ignores your foreign capital and foreign ventures, focusing strictly on what happens inside the geographical fence. Which brings us to Section 3, Navigating Dual Status Mechanics. So what happens when your physical and legal reality shifts midway through the year? You become a dual status individual. This means you qualify as both a non-resident and a resident for tax purposes in the exact same reporting cycle. As you can imagine, this is a massive headache and a highly critical edge case. The system cannot simply ignore one status in favor of the other. Instead, it forces these two distinct reporting mechanisms to collide mechanically, capturing your exact income exposure for specific fractions of the year based on the exact day your status officially flipped. Now, what's really interesting about this matrix is how simple the core rule actually is. To decode it, you just need to look at the absolute final day of the reporting year. Literally, your legal status at the stroke of midnight on December 31st dictates your primary form. The secondary form just acts as a supplement to cover the earlier months. If you end the year as a resident, Form 1040 is your primary filing, and you effectively staple Form 1040NR to the back of it to document the non-resident portion of the year. If you relinquish your residency and end the year as a non-resident, the structure flips. Form 1040NR sits on top as the primary, with Form 1040 attached as the supplement. The chronological endpoint strictly dictates the structural hierarchy of your paperwork. Let's move to Section 4. Treaty overrides and exceptions. This leads to an analytical question that challenges a huge implicit assumption. Can a domestic resident legally claim non-resident reporting status? A lot of people assume that meeting the substantial presence test is an inescapable trap, mathematically locking you into Form 1040 and worldwide taxation. However, expert analysis reveals a fascinating legal override. International tax treaties actually possess the sheer mechanical authority to completely supersede domestic statutes, shifting your classification despite your physical presence. And here's the exact mechanical sequence to force that legal override and change your default filing. First, you have to locate the specific tiebreaker residency provisions in an applicable international tax treaty. These rules can declare you a resident of a foreign jurisdiction despite your domestic physical presence. Second, you actively file the non-resident Form 1040NR instead of the default 1040. Third, and this is the absolute linchpin, guys, you must attach a formal treaty-based return position disclosure. Without that explicit paperwork acting as the mechanical trigger, the override completely fails. With it, you legally validate the reversion from resident to non-resident reporting. Finally, Section 5, Strategic Tax Liability Implications. Let's synthesize all this analysis. We really need to completely deconstruct a common misconception here. Holding domestic residency through physical presence does not automatically mandate taxation on your global income. If you properly execute those treaty overrides or closer connection exceptions we just talked about, that global chain is cleanly severed. Mastering the analytical boundary between these forms is exactly what allows for that legal severance to occur, completely transforming your financial exposure. So the crucial point is that the ultimate liability outcome is profoundly strategic. Form 1040 exposes all global earnings to the domestic tax base. It is comprehensive and it is unyielding. Form 1040NR liability, by its very design, acts as a territorial shield. It fundamentally walls off your foreign assets and foreign income streams from domestic taxation. For the globally mobile individual, successfully operating behind this non-resident shield almost always yields a significantly lower total tax liability. Which brings us to a final, provocative thought I want to leave you with today. If jurisdiction is merely a mechanism, just a set of strict rules, physical triggers, and precise forms, how might mastering the analytical boundaries between Form 1040 and Form 1040NR completely reshape the limits of your global mobility? Understanding these bureaucratic borders isn't just about checking the right compliance boxes, it's a profound strategic tool for capital preservation. Thank you so much for joining me for this explainer. Keep analyzing the mechanics, and I will see you next time.